All right, everyone, welcome back for another episode of Carnivore Trades. Today's Monday, June 5th, 2023. If you're not done so already, please give the video a thumbs up, like, comment, subscribe to the channel. Come find me on carnivoretrades.com for swing trading alerts and analysis. Anyways, we're back here with another interview for the Master Trader Series. It's been a while here since we've done one, but I really want to get, who I think only are the best here. And today we have an awesome guest. Been following him for a while. A little bit less of a technician. He's much more of in the macro space, but he posts great stuff on Twitter, amazing data, very active on there. Also on TraderAid here. Without further ado, welcoming Mayhem from Markets and Mayhem. How are you doing today?
Hey, doing well. How are you doing today, Aaron?
Awesome. Just getting the videos wrapped up for today and ready to get this interview going. Been pretty excited about this.
Awesome. Well, thanks for having me. I appreciate it.
Anytime. Awesome. All right, so yeah, let's kick it off here. So markets basically today, more of a flattish day. Spiders down about 20 basis points. Qs slightly in the green here. We did see semiconductors kind of pull back. Obviously, the big talk of the day was Apple. The Apple event. These things tend to be kind of a sell the news, and we just saw that hit an all-time high. And I mentioned earlier, they probably were going to get Apple to an all-time high before any sort of. It feels like the market participants right now are just kind of waiting for some type of a pullback. We know we're overbought and extended, and we got that psychological all-time high out of the way. And it looks like they did a little bit of a rug pull there, but I want to let you talk a little bit about kind of breadth. This is something that's been a hot topic lately. I mentioned Friday that, you look at the Russell 2000, that actually finally got a little bit of bid, and we saw breadth improve in the NASDAQ even on Friday. Dow transports were previously been lagging for a long time. Friday, they caught a bid. Today, that just seemed to go right out the window, and it was the usual suspects, right? Tesla, Apple, Meta. Obviously, Apple did roll over negative, but, the big cap tech names, the AI darlings. How long can this go on for here with breadth just being, and we'll get into some other divergences here, but how much longer can this go on for realistically without some type of pushback here in the markets?
We've got 15 stocks accounting for about 97% of the upside year to date. We have the narrowest number of stocks within the S&P beating the major average over the last month that we've seen since 2001. And there's a number of other shockingly bad breadth statistics. We did see last week, a week where NYSE and NASDAQ new highs outweighed new lows, but it was pretty marginal. It's not what you would expect to see if we were actually in some kind of bull market. And a lot of hopes were hung on the idea that, Apple was going to come out with some kind of revolutionary new product. And instead, it's a $7,000 new Mac Pro computer, update to their software, and a $3,500 VR headset that kind of prices them out of that market, except for maybe the very top tier of what's already an extremely niche market. So I don't think the market was, particularly thrilled with that, and Apple's selling off after hours here a little bit. But in terms of the narrow breadth, I think that this is something that going back 20 years, when we see this type of narrow leadership, it often precedes a leg down. And it's something that, typically when you're a money manager, you're basically long only. Most of the time you have to have about 95% of your cash deployed into assets, and most of those assets are going to be equities. So when they see the writing on the wall that something not so great is on the way, maybe a recession in the economy following this earnings recession, which we've now seen 2 quarters sequentially of negative earnings growth. So we're in an earnings recession. The question is whether an economic recession follows. I think it's quite likely it does, starting in the back half of this year. But this is what you see when people are chasing size as a factor for a heuristic of higher quality, trying to get out of the way. And so big tech becomes a de facto flight to safety mechanism. It's also the most concentrated part of the index, where in the S&P, it's 24% of the weight. And the NASDAQ, I think it's about 47% of the weight, the top 5 stocks. And so I think if we netted out this AI rally, we'd be flat to down year to date. A lot of the AI peripheral stocks are the leading drivers of this as well. So there's both hype and a bit of a flight to safety, with size being sort of a factor that people are chasing higher and higher. And that's one of the reasons that we see some of those divergences, is because people just aren't bidding a lot of the other sectors and factors.
Right. You look at equal weight S&P, that's basically up 1% for the whole year. Equal weight QQQ is green, but not nearly as much as, you know, the standard QQQ. In fact, we just made a new 52-week high on the equal weight. So, and again, it's obviously a AI driven, and the NVIDIAs of the world. I'm looking at Tesla right now. That's up 46% in the last 3 weeks, or excuse me, last 6 weeks. Apple up now 40%, 48% exactly, to the December and January lows. And it's like, these are $1 trillion companies or multi-billion dollar companies. So NVIDIA adding 200 billion in market cap in an hour after hours. We're not seeing that risk spread out. And, is there risk here when you get a high concentration into a small sector? Is that kind of, I made an analogy about a week or two ago. It's kind of like a building with like a fire, maximum occupancy. And let's say there's 100 people in that occupancy, but there's 300 people in the building. If somebody pulls the alarm, 20 people get out, the other 280 burn. Is that some type of a good analogy for what can happen here?
I mean, I do think the trade is getting crowded. And when a trade gets crowded, you have to start asking yourself how much money is left to come into that trade. And on the other side of it, we saw the largest inflows into technology stocks that we've ever seen over the last week. We've seen some extreme buying in NASDAQ call options and even S&P call options. The index put call ratio got to a level we haven't seen since March 3rd of 2020. And yeah, the market bottomed later, but 800 points lower later on the S&P cash. Now, that doesn't mean that we're going to follow that past as prologue, but it does tell us there's an extreme in euphoria and in optimism, not just in the concentration and how these stocks have run, with NVIDIA up 168% year to date, Meta up 125% year to date, AMD up 82% year to date, Tesla up 76% year to date. I mean, this is where really you look at the rest of the heat map. There's not much gains outside of the really big technology stocks. So I think it is a left tail amplifier. I think the left tail is becoming pretty obese at this point. I think that we are starting to see that we're sort of, especially in the NASDAQ, having this run up that is predicated more on a factor chase and a flight and a bit of FOMO, I would say, across the board, than anything that resembles improvement in fundamentals, improvement in the economy, or structural improvement in the market. And to have a sustainable rally, we would want it to be from wider breadth, lower valuations that are improving after we've seen an earnings trough and an economic trough and a meaningful change in central bank policy, such that the liquidity that this market really needs comes back in a volume that can really sustain it. So I think this is a bit dangerous. I'm looking at 4,300 on the S&P cash index as a pretty significant area of potential resistance, because that's where there's an absolutely enormous wall of calls. It also matches up technically with some levels we could watch the rally going back last year. And I think that it could prove to be sizable resistance. So certainly an area for more agile traders to consider raising cash into, or potentially fading as well, because the risk reward is pretty well defined there as we get into quarterly OPEX in the Fed.
Yeah, and another thing to add too, I mean, I know you're not a big technical guy, but today we just hit a 618 retrace from the all-time high to the October low, and we're also coming into that double top in August. So I mean, there is definitely technical resistance factors here as well. And you mentioned kind of about there's kind of like this optimism, but it's kind of misplaced. And you want to talk a little bit about kind of how you see the market here, or really the economy, and how more so how the bond market is acting. So I'm looking at the 2-year yield right now, and that is up at it's basically 4.5. So it's telling me it's behaving right now as if inflation's not over. It's more so what the data I'm kind of seeing is suggests more of a stagflationary environment. And I think the market is sort of pricing in this idea that the Fed just going to drop rates by 200-300 basis points pretty soon, and they're going to start turning the printers on. Is that something that you see happening? Is that something the bond market is telling us right now?
Well, I think the bond market is often trying to front run what it hopes or anticipates the Fed might do, and there's also hedging and other kinds of positioning that can lead to sort of divergent price outcomes versus what maybe the market expects versus what may be likely to happen. And the Fed funds futures market is certainly a place where there's a fair amount of that going on. So we've seen expectations shift from maybe there's going to be a rate hike in June to now maybe there's going to be a rate hike in July. I think it is more likely we see a hike in July, and I think 25 bips and then another hawkish pause is probably a pretty likely outcome there. But in terms of seeing a hike as early as what the market's pricing in now, November, I would be pretty surprised. My belief is that the Fed's real dual mandate is creating and popping bubbles, and we haven't finished the popping phase yet. There's a lot more to deal with in terms of asset inflation, in terms of real world inflation, and the only tool that the Fed has to deal with that is removing liquidity, making capital harder to access and more expensive if you can get it. And they're doing the best they can with that. And the bank implosions that we've had were actually constructive to the Fed's goals, and Chair Powell's even spoke to that effect, saying as much as the credit conditions tightening is doing some of the Fed's work for them. And the amount of credit conditions tightening that we've seen so far, we've never had this much tightening that a recession did not follow. We've never had more than 6 months of leading economic indicators since 1960 without a recession following. We've had 13 months of leading economic indicators in the negative so far. And we also have a pretty deeply inverted yield curve that's kind of flipping out of flattening to deepening. I think everything kind of models into a recession starting in the back half of this year. And there's a lot of other factors in the macro in terms of weakening consumers and business activity and overall economic activity that point to the same. So, the Fed will probably come around to start cutting, but not as soon as people think. I think there's still a lot of excess to flush out of the system. But the irony is that having policy as tight as it is for as long as it may be tight is actually going to tighten up the supply side too over the longer term.
Yeah, absolutely. And that's one of those kind of unintended consequences. And I think there was a little blurb. I'm not sure. Might have been Williams out of the Fed, and they kind of acknowledged that wait a minute, this actually can tighten supply, which could be even more inflationary. So in your mind, I would agree with you. We're headed for a recession here. It's pretty much the writing's on the wall. Would you say that it's more? Are we going to have a traditional type of recession, commodities crashing, job market, high unemployment, or is it going to be more of a grinding labor market remains tight and there's a higher floor in commodity prices, which obviously is a much worse outcome because it kind of holds the Fed back a little bit?
So I think the tightness of the labor market is going to have a lot to do with what is being done to kind of offset the recession. If we see more stimulus that winds up in people's pockets, if we see extensions of unemployment, if we see other things that keep the historically high amount of people sitting on the sidelines outside of the labor force on the sidelines, and we don't see that wipeout of wealth creation that's been in crypto and stocks and bonds and real estate that's allowed a lot of people to retire much earlier, then the labor force could remain structurally tight from the supply side. The demand side, we're already seeing some signs of slowing. Although non-farm payrolls was hotter than expected, the establishment survey is suggesting that there's actually a fair amount of jobs being lost, and the unemployment numbers suggest the same, with a rise in unemployment insurance claims. It's a bit of a contrast to what we're seeing in JOLTS and some of the other data, but I think at the very least, it suggests, along with the ISM services and ISM manufacturing data we got recently, that is showing some slowing in employment while prices are on the rise and while new orders are slowing in services and continuing their negative trajectory in manufacturing. That all does suggest hints of stagflation. And I think that's the type of environment we're likely to be in. But if we do see an economy where total debt to GDP across public, private, bank debt, and so forth is over 350%, and each dollar of debt spent by the government leads to a pretty suboptimal outcome. It actually takes $4.50 for every $1 of GDP growth. It's going to be hard to stimulate our way out of the recession in any meaningful way, with the current interest rate burden and with the amount of stimulus spending already in the pipeline and sort of extending out this 14-year credit cycle that the Fed's very intent to end. So I think the biggest question is going to be really, do we see the demand side break? Do we see employers really start to lay people off in a more significant way? And that's what I would start to look for in the back half of this year. But I'd look for it with one sign first. I'd look for ISM services to start to break. We've seen manufacturing break. We've had a decline over 9 months in the index. New orders have been obliterated. Backlogs are looking terrible. The entire space is very weak, but it's only about a quarter of the economy. If we look at services, it's still been hanging tough overall, but this last reading was just marginally positive at 50.6. So that tells us that not only was it weaker than forecast, but underneath the surface, there is some signs of slowing growth. The question is whether we start to see multi-month or sequential ISM services readings that are negative. And I think if we do, then employment's going to follow. And I think it's that sort of chain of events that leads us towards the path of a recession that's likely to be somewhat challenging, because I don't think the Fed's going to come to the rescue as early or with as much ammunition as people suspect. They're full well aware of the consequences of their monetary policy, not only in demand but supply, realizing that on the other side of it, they can't just go whole hog, cut to zero, and do Q eternity again. They've even talked about keeping QT going into the next cutting cycle, which would suggest that we could be in a much different environment. And then you look at the overlay of a tighter supply side, and it makes for a situation where inflation could come back from already higher prices, leading to a shorter, more volatile, and more shallow bull market in equities that's probably led by the older economy stocks on the other side of all of this.
I completely agree here. I think right now, at least for equities, it's you get the sense that they're kind of just pricing in like, well, at the first sign of any sort of real problem, the Fed's going to come to the rescue. So, and obviously it's much more complicated than that at this point, right? Like the Fed is trying to undo that policy. And ironically, the more the NASDAQ pumps up, you get that wealth effect in play. And the more the tougher it is for the Fed. And you mentioned fiscal spending. We're going into an election year, not too long. If we're into a recession, I would say it's likely that they're going to, at least the fiscal government is probably going to want to do some more spending. And that again, steps on the Fed's toes. So would you say that this environment here, the inflation and so on, is more secular, and we're seeing cyclical deflation or cyclical disinflation perhaps down the pipe right now?
Yeah, I do think that inflation's become structurally embedded for a number of different reasons. I mean, first, going back to the labor market, if we get back into an environment where demand rises and we still have this historically low labor force participation rate, then we have constraints there. We have an aging population. We have over 3 million people dying every year. There's just a little bit more than that being born every year. But on the other side of it, our influx of immigrants is only about 1 million a year. We probably need more influx of skilled workers. We probably need to lower those barriers to loosen the labor market. It's not even a political idea. It's just an economic reality. On the other side of it, we need to increase supply in all these key areas, whether it's energy, agriculture, metals. There's areas of necessity that, regardless of whether or not it's acceptable politically or in ESG or otherwise, we are a world that is more than 3/4 fueled by hydrocarbons. And there's no way to get off that. And certainly there's no way to create a bridge to a less hydrocarbon intensive future without using them to build that bridge. And so I think that we've done ourselves a tremendous disservice with all the overregulation and ESG stuff. But I think also the prioritization of investors over investing capex in expanding production and exploration in energy and other fields is highly problematic. For example, in 2021, we had the lowest new discoveries in the last 75 years in energy. And that's really a big problem. And when we do find energy, it's, we've got to go diagonal or sideways, half a mile down. We've got to go under the ocean. I mean, sure, there's still plenty in the Permian Basin for now, but we don't have the kinds of discoveries and reserves that we used to. And I think that's an issue as well. So getting away from hydrocarbons in a world of relative scarcity in so many areas, labor, energy, raw materials, agriculture, and capital, it's an issue, and it's going to be amplified in the next economic cycle, in my opinion, because I don't see any signs of governments or businesses changing that trajectory. And businesses, I don't blame them. If I'm a CEO of an oil company and you tell me wages are up and they keep going up, that the cost of capital is higher and it's harder to get, and then orders are going down, what am I going to do? I'm not going to expand supply into that environment. And it takes a long time to turn the spigot back on, because you've got to get rigs back in place, crews, you got to get permits. I mean, this is something that can take months, if not a year, to turn it back on. So, we're going from an era of tight supply in oil to one that could be tighter in the future structurally from a number of for a number of different reasons. And we see the OPEC cuts, and they have maybe a marginal impact, but the bigger question is what happens with more normalized demand in a less supply elastic world across all of these fronts.
Yeah, exactly. And, and you look at, these companies, the government's basically telling them, like, we're going to punish you for, drilling, but at the same time, we want you to drill so that we can get our ESG goals, in line and whatever. And even if they did say, go back on that, are these companies supposed to trust them? Because what if in 2 years they completely do a 180? Now you just spend all this CapEx, doing research, R&D, getting new permits, hiring people. And now they're going to completely renege on that. It makes it very challenging for these companies to even consider expanding CapEx.
Yeah, it's a challenging environment for a number of different industries, and it's unfortunately one that's likely to remain challenging. And in the U.S., you have this pretty binary political situation where, like you said, you never really know what's going to happen every 2 to 4 years, and how that might impact your company's ability to operate. So I think it's going to remain a constraint, and it's something that also will allow investing opportunities for swing trades and longer term investments. When we see an economic and earnings trough, I think that's going to lead to some opportunities in some of these older economy stocks, where there's some that have really strong balance sheets, really great margins, where there's plenty of free cash flow, low leverage, and they can leverage up and actually gain an advantage and start to produce and explore and expand their moat into that type of opportunity, into that type of economy. Because if we do see a recessionary environment, which I think we will, there's going to be some thinning out of the herd. We haven't seen a real recession really since the great financial crisis. And unfortunately, people have been led to believe that the R word is a bad word, that it's akin to profanity, that we should avoid it at all costs, that it's really bad. And unfortunately, that is a huge misconception. It's a very key part of free market capitalism. And having that flushes out all the excess risk, all the just zombie companies. Like if you look at the Russell 2000, there's 42% of those 2000 companies don't make any money.
Exactly. And, and another thing too, is it allows the consumer to reset, right? You have all this excess credit, excess saving, and they're in debt. You get the recession, well, yes, it's painful, but you can allow that to reset. And you could argue, and I've argued many times, that, by the government and the Fed not allowing for the Great Recession to actually play out. I mean, look at all the millennials that are priced out of the housing market permanently now. And you see this kind of anger and this unrest. And, these policymakers wonder why. Well, you've repressed and you've priced out an entire generation, and who knows what Gen Z is going to look like. I mean, so the business cycle, it's, they call it boom and bust for a reason, but it's a yin and a yang. And, this interventionist policy, it's finally coming to head after, 13 to 14 years here. And we're kind of in that bed right now.
And Gen Z is just not been given a chance. I mean, 40% of Gen Z 20s to 30s live with their families. And that same contingent is now experiencing delinquency rates that the same age group hasn't seen since 2010 on their credit cards. So we're starting to see some stress there. We know that in American households, most don't have even $400 in a savings account for some type of event. And about 60% of consumers are living paycheck to paycheck, and 40% are late on their bills. So we see stress increasing. We see subprime auto loans at delinquency rates we haven't seen since before the great financial crisis. There's just a lot of things to the lower tier and younger generations who are more vulnerable that tells us that really this is already a difficult situation. I mean, these folks are already living with their families most of the time. They're already seeing credit card stress increase. Then you've got the potential of $1.76 trillion of student loan, where a portion of those that debt, the federal portion, the there was a moratorium on paying it back, and that's likely to kick back in the next 30, 60 days, which is also going to be an increasing stress. In of itself, it's not a huge event, but when you add it with everything else we just talked about in combination with rising interest rates, and many people are borrowing on credit cards a record amount, over $1 trillion of credit card debt for the American consumer, it starts to hurt. And there's a lot of cumulative impacts from all of this tightening and weakening that we're seeing in the economy that starts to really play a drag effect on the consumer. And when we see the services industry slow and the labor market really start to deteriorate, as I expect, we're going to see these things come to a head, because some of the readings we're seeing from the consumer are worse than we've seen in prior recessions, and we're not even in one.
Right. And another thing too, it's in addition to the credit, I can't remember off the top of my head the exact data, but a growing number of people are using, services like Affirm and Afterpay just to pay groceries.
Yes.
So, I mean, that tells you what type of shape the consumer is in. If they can't even use a credit card, then maybe their credit card's already maxed out. They're using, Affirm, and those are probably going delinquent too. It's really tough, really in tough shape here. And again, like you said, with rising interest rates now, so those loans, and I mean, we can talk about commercial real estate if you want. We can talk about the lag effect on the interest rate hikes, which is usually about 12 to 18 months. And we're kind of getting into that sweet spot right now. Like, we haven't seen a ton of the data turn yet, but it's starting to get there, right? Where, it's one of those situations where it doesn't matter. And then all of a sudden it all matters all at once.
But Aaron, it's a Goldilocks economy.
Yeah, that's right. Well, no, the Fed's going to engineer a soft landing, because they've done that every time, right? Yeah.
Or no landing. We're just not even have a landing.
Yeah. That was a good one. That made me chuckle when they came up with that.
Yeah, it's got to get more ridiculous when the tail risk is even higher.
Yeah.
We've got to go for the biggest contrast possible. So from
we'll
very hard landing to none.
Yeah, we'll just do what's that, when they refuel a plane while it's in air?
Right.
One of those rescue missions. Yeah.
Yeah. Right. So I think that with commercial real estate, there are some significant headwinds. We have landowners and really in this sense, commercial property office building owners that are in serious trouble. They have the lowest occupancy rates in history. On the other side of it, they're staring right down a maturity wall that starts in the second half of this year and goes out for the next 2.5. And banks aren't really wanting to lend into this environment. And in fact, banks own about half of all commercial real estate debt, and 75% of that bank-owned commercial real estate debt is these regionals that are already much less likely to lend, because not only is their asset liability duration mismatch very, very problematic, but also over 2/3 of these regionals have more liabilities than assets. And so they have to shore up their balance sheet. And that means less lending. It means raising deposit rates. It means borrowing from the Fed from that punitive, ultra mega supersized discount window facility when they have to. But at the end of the day, it means less credit. And as credit conditions tightening, as much as they are, not just for consumers, but for commercial and industrial borrowers, that's a pretty problematic sign leading into a major refinancing cycle for commercial real estate, but most especially office buildings.
And another thing, like if they lend out and there's, God forbid, another bank run, that's what got them in trouble in the first place. They didn't have the reserves to cover. So, they're probably very hesitant, I would imagine, to send out these loans right now, especially with a consumer that, their credit ratings are falling because they can't even pay off their, Amazon Prime card.
Right. So if you're a bank right now, it makes a lot more sense to not lend, but instead park cash at the Fed's reverse repo facility or buy some bills from the Treasury. Because in either of those areas, you're guaranteed 100 cents back on the dollar, and it's very short duration, and you're getting a good yield, rather than lending to someone for a couple hundred basis points above that, and you're tying up your capital. And if you have a flight of deposits out, you're dead. And the other part about it is it's important to consider that there's only some assets that qualify. So if you go to the Fed, you say, hat in hand, I need money, or our bank's going out of business, they're not going to take the real estate loan that you gave out to some family. They're not going to take the small business loan. They're not going to take the credit card debt. What they will take at their newer facility for 100 cents on the dollar are treasuries and agency mortgage-backed securities. And that's really it. Maybe at the normal discount window and smaller size, they'll take some of this other stuff with a haircut. But at the end of the day, this was one of the reasons that First Republic failed, is they only had $40 billion in assets that were qualified for that window. They had over 100 billion in deposits that left very quickly, and so they were deeply, deeply underwater. And this is unfortunately a mismatch, but also a lack of qualifying assets that many of these regionals have. And there's varying degrees of commercial real estate exposure, but some of these things have twice the amount of their exposure to commercial real estate loans and they have actually deposits backing that. So there's some issues going on into this that concern me a great deal looking at the sector. And back in Feb 2nd 2023, I wrote an article on macrovisor.com, which is a publication that my partner and I co-founded this year. And in that article, the first one that kind of kicked it all off, I identified there was over $600 billion of unrealized losses in the banking system, that there was growing borrowing at the Fed's discount window, and that the bank buffer or capitalization that they had right at that moment was at the lowest level since 2006, going into the great financial crisis that followed about 2 years later. And this was all rather alarming because we saw a rate hiking cycle where banks only hedged about 6% of their assets. And of course, if you're a regional, unless you're really big, you don't even have access to interest rate swaps. You can't short treasuries. You have very few hedging options. It's very complex to work around this type of tightening cycle.
Yeah, absolutely. Another area here before we shift gears just a little bit. I'd be remiss if I didn't ask you about home builders here. So I'm looking at the ITB and XHB. They're at 52-week highs. I have some clients and some members of mine who are in construction and specifically home building. And this is anecdotal, but they've told me that their respective businesses or their friends that have these businesses have seen their worst quarter ever for new orders. And, 10, 15 year business, and their worst quarter ever. Yeah, their sales, they're just keep going through the roof here. But what people don't understand is that, again, it operates on a lag effect. And these contracts, a lot of these contracts that they're making money on now were done during 0% interest rates. And that's obviously going to change, I would say in the second half of the year. I've said here, the home builders are probably one of the most overvalued sectors here. If you can take kind of a macro view of it, is there anything that you see there, or am I crazy to think that, or?
So it's a complex situation. I think you're fundamentally right. The question is one of timing, but it's a complex situation because on the other side of it, this very aggressive Fed tightening cycle has created an inordinately inelastic supply of existing homes. Because if you financed your home at 2.5 to 3.5%, what motivation do you have to buy a home right now? So then what motivation do you have to sell your home right now? So on that side, there's a lot of supply inelasticity that's sort of supporting houseflation. On the new sales side, this is the only reason that home builders really have such a strong bid, is that home builders have become the sole conduit for all the new supply, but that's slowing down. New orders and backlogs are down materially. And remember, home builders are an industry that are not only cyclical, but they also have revolving credit. Right. So a lot of these industries do. And it's one of the reasons why you might see this sort of coincidental peak in the industry. At the same time, you see, the Fed kind of getting closer to the top of their hiking cycle where those cumulative impacts of all that hiking really start to hit. And that is that when you're borrowing on a revolving line of credit and you've seen interest rates go up about 500 bips, your cost of doing business has risen, but your output product is going down in price. New home sale prices continue to fall. It's not a straight path down, but overall it has been a path lower since the summer of 2022. So we've got about a year of a housing recession that's been happening. So that means that margins are getting squeezed. So rising cost of capital, rising wages, rising cost of construction materials last couple of months, and on the other side of it, falling price of new houses. So yeah, I do think it's a sector that is priced with some degree of unhinged optimism. And this is something you typically see as you're in the end cycle environment and you get these head fakes where people are reflexively thinking, oh, it has to be a new bull market again. The worst is behind us. So let's bid up all these early cycle and cyclical type of plays like tech and home builders and some of the other areas like semis. And I think at the end of the day, people are naturally very optimistic about the U.S. It's very hard to bet against the U.S. We've had 14 years where the Fed has been aggressively backstopping the market, selling puts left and right. And people have been wired into that, not realizing this hiking cycle is actually different because the bogeyman of inflation is not becoming subdued. Services-driven inflation in particular has become very structurally embedded. And And the Fed has directly identified that and wages rising as primary concerns, and neither are at levels that make them comfortable, which means rates stay higher. They could go a bit higher than they are now, but they stay at this level or a little bit higher for a lot longer than the market expects, and the balance sheet continues to get run off. And so what does that do to the cost of a mortgage? What does that do to the cost of buying a new home? Home ownership costs have never been this high. We've priced out entire generations. You've got older folks that sadly are going into retirement, or even worse, dying. If they're going into retirement, or downsizing. If dying, the home's being sold too. But on the other side of it, where's the whole group of folks that would normally, as younger people, be buying these houses? They're effectively priced out. Eventually that starts to matter. And the other problem here on the supply side, that I think this is sort of the dam that busts, you've got a lot of people that sort of became Airbnb buyers of homes to speculate in the vacation market, and also landlords buying second, third, fourth homes, rental properties and apartments, etc. And as soon as the going gets tough enough, when we start to see higher unemployment and people can't maintain the mortgages on those additional properties, or they see their tenants start to default or otherwise, I think we see a supply come in from all of that, from the Airbnb properties when the revenge spend trend of traveling is over, or wrapping up to levels that give them more pressure. And then the rental side, when more job loss is happening, and it puts pressure on both the lease holder and the landlord. And once you start to see that supply unlock, you're going to have motivated sellers that makes it a buyer's market, which means prices are likely to go lower. And I think when you have that competition combined with the dropping supply, the pressures on margins for home builders are already facing, all that seeming like it's a second half of the year type of theme, yeah, I think that it is a sector where there is opportunity to the short side, not only from a technical perspective, because it's starting to look pretty exhausted. I mean, I'd rather see it cross below the point of control, which on my chart's just below 70 here, and maybe break this trend line that I've got drawn going back from October, which would be around 68. But if we could get a bit lower, put in a convincing top, I think there's a lot of meat on the bone of this as a potential short.
I agree. You're talking about the XHB or the ITB? I mean, they're almost the
I
same price
I
tag.
like XHB because my
Yeah,
recollection is it's not so heavy into Home Depot and Lowe's, which could actually do a little
yes,
better than the builders.
that's correct. I think XHB has, I think it has Lowe's, but ITB's got Sherwin-Williams. It's got more of those retailers in there, so it's more of a retail play. So the XHB is more of a pure play. But yeah, you know, and another thing too. I mean, some of these home builders are doing layoffs too. You know, what does that tell you about their future sales? You know, so that's just something to consider here. But
You
excellent response.
You're also seeing weakness in construction sales and rentals for, equipment that would typically be used in small scale commercial and residential projects. You see multifamily unit sales down significantly as well, which is just suggesting in aggregate demand is starting to go down for this stuff. And construction is becoming extremely expensive to finance. So I just feel like these guys are all going to have to throttle their and they're already seeing it in their pipeline. So they don't really have much of a choice.
Yeah, absolutely. All right, let's shift gears a little bit here. We kind of sort of touched on it a little bit at first. We got close, but I want to talk. So we talked about divergences and like breadth. Dow theory, the transport should be leading in a bull market, and they've been making lower highs since February. And markets have defied gravity, so that's going on. Another one that you've talked about a lot, and I know I've talked about it in my channel a lot. QQQ TLT, right? I mean, those are some big alligator jaws. Can you explain to the viewers that essentially what that relationship is and why those jaws have to close shut at some point, and essentially what that dynamic is?
Yeah, so really for the better part of the last 2.5 years, the relationship between the performance of longer duration U.S. sovereign debt, or the 20 to 30, or even 10 to 20 to 30 spectrum of the yield curve. If we look at the price of those bonds versus the price of tech stocks, in particular the QQQ and the QQQ equal weighted, there's a pretty high positive correlation most of the time. And when there's a divergence where bonds prices are falling and the NASDAQ's price is rising, typically the chart is a quick and easy way to see that risk premiums are starting to get very thin, if not go negative, which just suggests that this tech stuff, this longer duration risk, is getting wildly overpriced, that there's much better opportunities in fixed income, but there's also reasons to see it take a bigger haircut. And so I look at it as a indicator of when things are getting stretched. And I like to see it mirrored elsewhere. And we see it mirrored in the options market and the kind of bullishness and complacency there is there. We also see it mirrored in positioning and flows. We see extreme long positioning, flipping skew and calls of many tech stocks back, back deeply into calls away from puts where it had been for about a year. And we also see some of that happening in the positioning in the stocks themselves, where there's just enormous amounts of inflows, the largest inflows we've ever seen into tech. So I think all of that in combination with that divergence suggests that this is a bit of a blow off. I don't know that it's the ultimate top, but if it does start to reverse just as violently as this parabolic move happened, I think it's going to make that scenario more likely. I would say this: when you have so much upside concentrated in so few stocks, the risk that any one stock has an issue and that drags the entire market lower becomes much more palpable.
Yeah, absolutely. Like, for instance, an NVIDIA, 20% up, but if it comes down, it's going to add that weight. Speaking of calls and, blow off, you've done some great work on zero DTE. And a hot topic right now is the VIX, obviously, basically making a 3-year low, essentially.
Yeah.
How much of that skew, how much of this is actual complacency? Because if the VIX is crashing, right, it's a general good sign of complacency, especially if it had an extreme low. But how much does the zero DTE skew that? Is that kind of, is that giving us a bad reading there? And similarly, like the put call ratio, is that creating some skew as well?
I would say that, in terms of skew, we're seeing skew towards put premium significantly higher than anything we've seen since 2021. And it did drop quite a bit today, but going into today, it was quite high at about 156 on the index. So
Yeah.
that was just indicating to us that, looking at hedging is actually rather robust. And we see that often is the case that people are using these puts to reduce value at risk so they can lever up. And we see that in the positioning and the flows into tech. So we think that that's a good amount of the levering up that's happening into some of these concentrated plays. On the other side of it, when we look at put call ratio on the index level in particular, it's noteworthy because typically index options are used for hedging, but now we have more index option level FOMO. People are just buying calls in the NASDAQ and the S&P, but in particular in NDX and in size we've never seen before. So that's noteworthy as well. And that's telling us that there's a lot more bullishness, which is going to trim off some of the demand that we see for put premium as well. People just aren't necessarily as engaged. So I would say that that's part of it, particularly in the single stocks. Put premium is much less in demand in these popular sectors. But then when we look at the VIX itself, volatility is not the same as it used to be because you have so much concentration in short dated options positioning. It's gotten to the point now where almost 50% of all volume traded every day in the options market is traded for options that are expiring in 6.5 hours or less. 70% of all notional value traded every single day is traded in options versus futures or indexes or ETFs or single stocks. There's so much options related activity now. It's about $1 trillion a day in the SPX, half a trillion almost in the options that are expiring the same day. So when you've got that many people that are expressing their opinion near to the money or in the money, and they're doing so with very short expiration, then the VIX, which is just an uncertainty measure looking 30 days out, well, the opinions being expressed don't look so uncertain. And so that creates a compression effect in the VIX. So I'd say the 30-day VIX doesn't have much value anymore. The CBOE did make a 9-day VIX. It also doesn't have much value because about 75% of the options volume is in options that are expiring in 4 days or less. Now there is a 0-day VIX for the same day, which is it's been a little wonky. I'm not a huge fan of it. People that are volatility quants tend to look more at fixed strike volatility, which has been on the rise. I think that's probably going to be a better place to look as a substitute. But at the end of the day, I think the other thing is it's important to look backwards and really take into consideration what realized volatility is telling us. So, if I'm looking at, implied vol moving forward, I'm just using a 5-day forward looking time period. And then looking backwards, I'm looking about 10, 15 trading days. So I like to look at IVol versus RVol, or implied vol versus realized vol, to get a sense as to whether the market, the hedging that's in place, or the expectation of price movement is cheap or expensive in terms of what volatility is telling me. But I would say that in terms of the traditional VIX having much signal value, at this point, sadly, it doesn't. And then adding into all of this, you've also got vol selling funds. They're back in a big way over the last, 5 months or so. And they're continuing to add to that vol compression effect as well.
Yeah, I've said before about zero DT, it's almost like every day is its own business cycle now, because as soon as 4 p.m. hits, all that stuff rolls off and it's gone. So it's a very strange environment. Would you say that, you going back to, I believe it was November 14th last year that they started doing it? It looks, it looks as if not just the VIX, but I'm just looking at chart the S&P. We know how choppy it's been this year. It's as if, would you say that it's accurate to say that zero DTE is really compressing volatility on both sides, not just in actual, in the actual VIX and actual premiums?
You mean on the realized side as well? Yeah,
Yeah.
I would say so, to a degree, because you do have more people expressing greater amounts of opinion closer to the money, and sometimes in the money, and with a very short time horizon. So that's also going to affect actual price movement. The other side of this is also, particularly on up days, you've got put premium being sold to fund the buying of call premium on a same day expiration basis. And that also helps to reduce the VIX and just really start to create some interesting effects in the options market. I mean, you're basically accelerating some of that delta decay. So you start to get Vanna effects kind of happening earlier than they would otherwise. So I think it is definitely something that's changed the overall dynamics of the market. And, the questions I have are, what happens if it stops? And then also, what happens if it goes the other way? And you start to see call premium sold to fund the buying of put premium. And you could have a pretty significant turn of events that I don't think it would be a vol compressor in that scenario.
There's been speculation too, we know the Wall Street bets crowd and stuff, but what if they, there's that like that saying, what if one of them figures out what, you can do the same thing with puts essentially that you can do with calls. It's just gamma. And, let's say, just throwing it out there, today, the White House released a statement saying that it's getting tenser in Taiwan. The market is complete. Look at the semiconductors. It's completely priced out the possibility of something happening. Let's just say something like that or some black swan happens. You can get a blowout to the downside just as easily as we're seeing to the upside.
Yeah, absolutely. And I think that there is a lot of mispriced risk in this market. We're in an earnings recession with the largest leadership in the market trading as if it's growing, and it's not. And I think those valuations are unhinged, and I think that's a bit dangerous. I think that we're starting to see the NASDAQ ridiculously overbought, at least by some measures, maybe not by the McClellan oscillator, but RSI, what is it, 79, 80? I mean, it's really quite up there. And I think that when we look at the macro picture, eventually it's going to matter in a pretty material way, because these are companies that are going to continue to see downside pressure from the economy. Google makes 80-90% of their revenue from ads. Meta is something like 96%. Ads are the easiest thing for businesses to cut when they're under pressure. And that's a huge feeder of this digital economy. And then when you look at Apple and Netflix, there's a lot of discretionary services the companies sell. There's the hardware refresh cycle at Apple that can be slowed. There's a lot of reasons to think that these companies and the earnings cycles that we've seen haven't yet demonstrated just how fragile things are for the consumer and what things look like on the other side of what seems to be a more and more likely recession. So I don't think that we've really seen a market that's realistically priced in anything. I've heard on financial media, back in October, the market priced in a recession and now it's moved on. I've never seen the market just sort of price in something and then move on before it even happens, like something as serious as a recession. I think that if we do have a recession and it starts to happen in the back half of this year, we're likely to see a pretty significant haircut across the board, but particularly in these leadership stocks that have been so concentrated.
But doesn't AI fix this though?
Yeah, I mean, it does. It does, because what it
Yeah,
does is it realizes that markets are inefficient and sends them all to zero.
but Nvidia is only at 38 times revenue, so there's no issues there.
No, it's fine. I
Yeah,
mean, we
yeah.
obviously need all of their new what is it, H200 supercomputer offerings so that we can have Chat GPT take over every single human job on Earth.
Yeah. And another thing, what you said about the market pricing something in and then just disregarding it. I don't think there's ever been a bull market that started with an inverted yield curve. At least that was one that lasted more than 6 weeks. And we're coming up on a year now that the 2s and 10s have been inverted.
Yeah, and it's funny because if it was a new bull market, it would be from the highest valuations that a U.S. Bull
Exactly.
market has ever started from. We haven't typically seen one before the Fed started to aggressively ease. Typically, it's 10 months out from the first cuts. Typically, it happens, the bottom happens when the context of an earnings recession, if not an economic recession, and when it's troughing. And we've seen none of the things. We haven't even seen a massive de-risking from retail, who has nearly the most percentage of their net worth invested in equities ever. And the time where it was at its historic high was in 2021. So it's just ebbing off of an all-time high. None of this, and there's usually a huge exodus. And so none of these things have happened, which tells me that, really, this is sort of the calm before the storm. And I think if we go back to the dot-com bust, we had 5 or 6 new bull markets in the NASDAQ, some of them raising up 30-40% from the lows before they ultimately made new lows.
Yeah.
And then we had a 10-year sideways chop. So I think that we've had such an extraordinary bull market and credit cycle that it's actually gotten to the point where people have kind of forgotten what a real bear market or recession looks like. And they just look at the COVID crash or the 2018 tightening tantrum and think, oh, the Fed will come to the rescue. Everything will be fine.
Right. It's, yeah, you have a 3-month correction and it's all over with.
Right. Exactly.
Yeah. All right. Let's move on. So we've been going almost an hour here. I got to get to 1 or 2 more things though, and then I'll let you
Sure.
go. But I'm saving the best for last year. At least I think there's the elephant in the room right now, and that's the TGA refill, right?
Yeah.
Some people are saying that, well, the reverse repo can just soak all of it up and don't worry about that. And they're also saying that, well, it's priced in. My counter to that is, how can it be priced in when the NASDAQ's up 13% in the last 5 weeks? Is that something that's, a legit thing? Is that really going to come into play, or is it going to be a nothing burger and we're just going to go, to QQQ 380 in the next 2 weeks?
Well, my partner Aisha once said, if everything is priced in, then why does the market even open? Why does it move? Right.
Right.
So I think that the idea that this is all priced in and everything's all priced in, we've priced in a potential recession, we've priced in, an extraordinary, a historic issuance of treasury debt. I think that's a fallacy. I think it's copium, and I think it's, it's unfortunate that people think that way. I think the bigger question is, how does this issuance get absorbed? And, if there's going to be a capital flight out of reverse repo, then it would suggest that we're in a situation where banks are liquid enough that they can withstand a flight of deposits and they can hold bills to maturity, or go to the Fed's window and borrow against those bills, which I don't even think they'd be able to do, because I'm pretty sure the way the window works is it's for debt that they've owned prior to the opening of the window. So if my understanding of that is correct, I believe it is, then they couldn't even do that. So really, you've got over 2 trillion parked in reverse repo because you're earning 5.05% overnight. It's extremely liquid. So if you have a flight on deposits, or you need to put the capital to use elsewhere, or whatever the case may be, you pull it out the next day. It's all fine. I think that there's hesitancy of buying bills, and there's been plenty of issuance last year. Why wasn't that soaked up by the reverse repo, is the first thing I ask those folks. And it's because banks need a place where they can earn yield, but where they can be extraordinarily liquid. Now, sure, you can sell bills in the secondary market. You might take a little bit of a haircut doing so. It's not necessarily something that banks are going to want to do. I think reverse repo offers some degree of elegance for that. So I would say it's less likely reverse repo sucks up a material amount of that issuance unless it's in excess of 6%. I think if it's in excess of 6%, that's enough of a premium where you could see some of those folks more willing to say, okay, you know what, I'll cash out a portion from reverse repo and start putting it into some of these shorter dated maturities of the bills issuance. But I don't think it's going to be material enough to soak up the scale of the issuance, which is estimated at this point to be in excess of 1.2 trillion, potentially as high as 1.6 trillion by the end of the government's fiscal year, which is September 30th, and 700 billion of that happening really within several weeks of today. Because there's a lot of bills that are outstanding that are having to be issued. And remember, this is a treasury that's been on pause since mid-January. So they've got a backlog of so much issuance they have to do in a short period of time. And I think, first they have this second to last quarter, their third quarter, that they're going to have a lot of issuance in until the end of June. And then they've got their last quarter till September 30th. And they've got plenty more issuance to satisfy their budget. And you know how the government works. If they don't get everything for their budget and a department runs that way without all that money, it's harder to get the budget next year. So no one wants to even have that conversation. So there's going to be plenty of issuance coming up. And we'll have to monitor what the daily reverse repos look like. I don't think they're going to be a lot different, but we'll be watching that. My expectation is that we have 2 or 3 kind of coalescent themes that are happening here. One is the Treasury is going from spend from the TGA, which creates high velocity liquidity that enters bank reserves because the Treasury is paying bills. And then, often is the case, whoever gets the money has to then pay bills. So it goes through different bank reserves. And typically it's not quite as stimulative as, say, central bank QE, but it's still stimulative in aggregate. But on the other side of that, you've got a Treasury that's not doing that anymore. They're actually issuing debt, which soaks up bank reserves and soaks up excess liquidity. It tempts people out of equity markets because you get risk-free tax advantage returns in these bills yielding in excess of 5%. Then on the other side of that, you've got, more liquidity that just tends to evaporate in the summer. The summer doldrums really start in June. You've got, usually less book depth across treasuries, equities, currencies, commodities. That tends to make things a little bit more choppy and volatile. And then I think on the other side of all of that, you also have the impacts of QT being magnified because you've got that liquidity sponge from the Treasury issuance, plus the $95 billion run rate of the QT program of the Fed. You've got the ECB started QT in March. Yet you certainly have some offsetting effects from the Bank of Japan and People's Bank of China. But I have a feeling that the People's Bank of China, they've got so many problems in China with the real estate market. A lot of that liquidity is going to be absorbed domestically. And in Japan, sure, some of it's always going to come over with a carry trade. But I think the offsetting effects of everything put together is going to be big enough that now we're going to finally be off of what I've called QT vacation, which really started in mid-October of last year and then got amplified in January. Now we're on the other side of that. So I don't have the most constructive outlook as to what the environment looks like in that situation. I think it's going to be much choppier. I think there's going to be liquidity issues in a number of these different markets. And I think it amplifies tail risk in either direction because you get this sort of leptocritic distribution of risk where if you have less participation in the order book, it takes less volume to move price more.
Right. And another thing too is we had reverse repo in January 2022. And the Treasury had to issue a lot of new debt. And what happened to the price of stocks?
Right. It wasn't constructive.
Right. It's not like, reverse repo is just the magic fix. So, I know people can see, it's general optimism there, but I definitely think it's a risk. And it's also, I believe it's set to start on the 15th, if I'm not mistaken.
Yeah, I think that's where the bulk of the issuance is going to kick in.
And is it funny how these things work? That's going to be right before June OPEX and right after the next FOMC and right before quarterly OPEX too. So lots of convergence going on here in the next couple of weeks should make for some interesting trading here.
Yeah, absolutely. I think we're going to be in for a summer of some fireworks, volatility in both directions, but I think that we're going to retrace a lot of this bear market rally. I don't think it's sustainable. I think the S&P trading near 4,300 is an opportunity to raise cash and potentially lean short into some of these areas that have had these extraordinary runs. And on the other side, there's great opportunities in pair trades. I love the idea of fading high beta and going long low vol. I love the idea of fading growth and going long value. I love the idea of fading China and going long Japan. I think there's trade opportunities out there everywhere.
Yeah, absolutely. I was just going to ask you about that before we wrap up here. I know you definitely had recently had that idea long Japan, short China, and that worked out very well. Is there any other, as we're wrapping up here, any other second half projections or any other little trade ideas that, at least looks intriguing or somewhat attractive here as we get into the back half?
Yeah, I think it's interesting to look at fading copper. I think it's interesting to look at fading gold. I think it's interesting to look at fading silver. I'm still constructive on dollars. I still think fading the yen versus the dollar and fading the euro versus the dollar all makes sense. And the reason I'm not particularly constructive on gold is I think that this issuance is likely to pressure rates in the dollar higher, which tend to move in tandem. And that's not going to be great, particularly with rates heading higher in real terms. And, gold's bid was a lot to do with this bid against, it's sort of become a hedge against uncertainty. And a lot of the uncertainty is being taken off the table in terms of, what's going to happen. Are we going to have some default? Or are we going to have some of this, sort of chaos unleashed? And of course, there was a zero probability of that event the whole time. But gold was bid up into that. It's also going to get bid up into the recession when it eventually happens. But between now and then, I think there's some room for the yellow metal to move a bit sideways, particularly if we see rates and the dollar moving higher. So that's kind of the setups I'm looking at. I also think that a lot of the long duration risk assets, whether it's growth, whether it's tech, biotech, crypto, I think they're all areas where it's primed to harvest gains if one has them, and look at tactical short deployment, because there's a lot of stuff out there that is stretched beyond belief, that makes no sense at these valuations, and absolutely could get destroyed if we go into a true late cycle environment where the bear starts to really let's say re-rate the risk of some of these things that have run.
Yeah, and especially if you get, volatility to finally unpin, that's where the real risk comes in, because if you get negative news, then there's no shorts to cover, and then vol actually gets bid up, and it kind of selling begets selling, and that type of thing happens.
Yeah, absolutely. And you get the vol funds that actually have to start to distribute their equity holdings as well, which can really amplify that cycle.
Yeah, and with on gold too, historically, another thing that I'll agree with is that typically gold bids up before the recession, and then once you start to get the recession into swing, it starts to fade. Generally, it bottoms before everything, so it can be a great buying opportunity. But I agree with you; it's probably going to come under pressure here as the recession gets going. Will ultimately, I would think, set up a pretty good buying opportunity. But I would definitely agree with that sentiment as well.
Yeah, I think there'll be all kinds of opportunities over the summer. It's going to be a sort of probably a bit of a mean reversion summer for this market. And if anything, that's a good thing. I mean, for anyone out there that's listening that thinks that, we're too bearish, I would just remind every single long-term investor that we want long-term sustainable returns. And the basis of that is being able to buy in at reasonable valuations, because that's where your long-term returns start from. They start at buying from reasonable valuations. If we buy at these valuations, our long-term returns are likely to be subdued, if not negative. So it's really important context. Yeah, the market tends to move up and to the right on a chart over long periods of time, but entry point makes a huge difference in terms of whether or not you're waiting to break even after years, or whether you're starting to make money during a generational opportunity that could come in during an earnings trough and economic trough that could be in the months ahead.
Yeah, absolutely. And people sometimes they think I'm a perma bear, but I was massively long in late December. I'm a trader. I'll trade. I was long a bunch of times last year, was short a bunch of times last year. But right now, I think I see the same thing that you see. I mean, we're seeing this heavy calls into big tech, FOMO, stretched beyond belief, and we're seeing these divergences under the surface. That doesn't mean that they can't last. They do last. They tend to last longer than you think, but they also end before you think that they're ending. A lot of the time, like last year when we topped out in August and in March, I told my traders, I was like, look for the top to look kind of like a pullback, and then you'll get the big leg down, and it goes before you're ready. So
Yeah.
It's one of those situations where you got to be careful. You got to always be on your toes when you're in this environment.
Yes, absolutely. I think agility is key. We could see volatility return as a theme. One thing that I would leave the listeners with is that there is a correlation between low volatility and high liquidity, just as much as there's a correlation between low liquidity and high volatility. And if we do really see that liquidity rug pull event that we may, and it's not going to be all at once, it'll be slowly and then all at once. But if that
Right.
does happen, that's where you start to see volatility really come back. So remember, there's less depth in the book. If there's less folks willing to absorb order flow, and that flow has a more profound impact on price discovery. So let's all keep that in mind as we trade through what may be a more illiquid summer.
Absolutely. All right. Awesome chat, man. Went a little bit longer, but that's great. Though I've been having a great time. Awesome information in here. Thank you very much, Mayhem, for coming on. Before we get going, where can everybody find you on social media and on your website, etc.?
Sure. Yeah, absolutely. Thanks so much for having me on, Aaron. It was a great conversation. Really appreciate the invite. You can find me on Twitter at Mayhem4Markets. That's Mayhem number 4Markets. Find me on YouTube at youtube.com/at Mayhem4Markets. My current projects right now are traderaid.com, where we help short to intermediate term traders with technical and macro driven analysis to cut through the noise and provide edge and signal to our audience. And then macrovisor.com, where we help intermediate to longer term traders and investors learn more about the macro, make it understandable and actionable.
Awesome stuff, man. Thanks once again for coming on. You take care. Hopefully we'll get to do this again soon. And hope for the listeners, don't forget to subscribe to him, subscribe to carnivoretrades.com, hit the like button. You guys take care.